Okay, so here's the chart of the Dow. Very similar to basically the YN. Chart is the chart. So let me annotate this. So the question is, how to determine turning points? Well, before we do that, let's go through very quickly in regards to price. Since everything is translated into a chart based on price, where there's an open, high, low, close. That's mainly the only major data that we currently have is the opening price, high price, low price, closing price, depending on the time frame. So there's two components in regards to technical analysis. You have your price, and then you have time. That's basically it. Time and price based on x-axis and the y-axis. On the other hand, since we are forecasters, we are technical analysts. If the definition of technical analysis is simply the study of price movement to forecast future price movement using present and past price movement. So if that's the definition and the keyword is forecasting, then the question now is, what is forecasting? What is your definition of forecasting, Jerome?
Everything from accurate to a best guess of predicting movement.
Okay. Since forecasting, we can't really predict, and the reason being is because prediction, just in my opinion, if you look at the definition, is very subjective based on prediction. Is subjective based on perception. Based on what we think. On the other hand, to forecast the price is not predicting, because you're now dealing here with objectivity using a statistical data using statistics to create probabilities. To create a probability. What is a probability? A probability is simply a measurement of approximately where it could potentially go. So the market technically can only go only three ways, right? So it can only go up, down, or sideways. So if the probability is 33% at a starting point, but if you have more, so statistical data, you need to find the data to create the probability, to increase the probability of 33% and above. Now, once you have all that pieces of information, and if you're now choosing, notice the word choosing, you're not deciding, you're choosing either to buy or sell, because at the end of the day, that's the only thing that you're going to do. Either you want to buy or you want to sell. Then that 33% increases now to 50-50. It's a 50% probability when you're buying something. Now, price will only go to one direction. It cannot go simultaneously in both directions. Either it will go to your target point, or either it will go to your stop loss point. That's it. No more, no less. It can't go both where it's going to go to your target and stop loss at the same time. So the question now is, what is this data that you need to look at to create the probability of win? technical analysis alone is not enough ample evidence in order for you to go in. There has to be more than that by looking at the macro fundamental now component of it. So one is what would cause the Dow to go up or down, what would cause the S&P to go up or down. In my opinion, I believe the central hub is the dollar index, and the dollar index is what drives basically the whole global economy to a certain extent, especially here in the US. The question is as well, what drives price to go up or down? Well, price is driven by what do you think, Jerome?
Supply and demand.
But what causes supply and demand on the other hand?
Buyers and sellers.
What causes buyers and sellers to buy or sell?
Everything from algos to a hunch.
So there's only one thing, right? Just think about it. Like, say for example, if you're gonna buy the property in Mountain View and everything is all inflated, what's the only thing that you will have in order for you to buy that property?
Expected gain.
The gain, but before you have that expected gain, you need something even before you put your money into it to do your homework. So what causes for the price to be evaluated to a certain price point?
Best use of capital.
So for example, let's take the Dow right here. Who dictates that the price will be at 26,675? Like, what causes for the price to get up in there? What causes for the price simply to go up based on demand? So if you're a buyer, what will input you in order for you to buy? Even from an institutional standpoint, even from a developer's standpoint.
Momentum, maybe.
But even before that momentum has to be created, there has to be something. There's a source. So what is the source?
Story and event.
Event that creates now is driven by news, whether we like it or not. So everything you see there is based on the news that is being affected minute by minute basis globally, not just in the US, Europe, Asia. So everything is being driven, and hence is why you have a futures price that will track down the price of the S&P, and that's why you trade futures, the YMs, the E-minis, oil, gold, or whatever you want to trade contract. That's why it's called the futures components, because they need to track that price globally. It can't just be because, I mean, it doesn't necessarily mean that the price in the here or once the US market closes, it doesn't end there, because it also has to track all the price points from Europe, say Coca-Cola, for example, right? I mean, people drink it all globally. So in any event that will happen, price will be affected by it. So if you have good news, the price will go up. Sometimes good news, the price will drop. Sometimes bad news, the price will go up. Sometimes bad news, the price will basically drop. So it's all being dictated by news. And within that news, when there's news, and that's what creates the volatility of price, is because it creates the fear. So for example, war has been broken. Now there is uncertainty of events, and that's what the volatility index is simply being calculated, is through fear, through uncertainty. They don't know where price is going to go, right? At this point in time, volatility index, look at that, there's no volatility. So option traders do not like it when there's no volatility. Option traders love when there's volatility. Day traders do not like it when there's no volatility either, because people won't make any money. It's flatline, right? So if there is no volatility and there's a lot of certainty, then the price will just hover through a sideways movement. So right at this point in time, notice that the volatility is 0.97%, and notice in the S&P, on the other hand, is at 0.82%. So that automatically means, as a trader, based on the data being given, there's some form of divergence happening between the volatility and the S&P. So technically, if the S&P is up 0.83%, the volatility index should be where? More than 0.97%. It should be at least below 12, or it should be around 11, probably around the 10. So the question is, why isn't it moving? That is something, as you, as a trader now, that's your job, is to figure it out what's going on. In terms of divergence, divergence is simply your leading indicator, not your momentum, not your stochastics, RSI, because they're all lagging. That's why to go through the macro fundamentals aspect of it that creates some form of divergence, because if this is what we're looking for, is the data to create the probability, it will increase now your probability, and you have a high probability, then that's where you enter. You have a low probability, you're not going to enter. Other than that, if you don't have enough evidence, then you're just basically using subjectivity to predict a price. When you're predicting price based on your own perception, you're screwed, and that means you're just basically gambling. You don't want to do that, right? Because it's very subjective. Hence, so to look at a chart, one will say will go up, one will say it will drop, one will buy, one will sell. That creates the market itself, because when there's a buyer, there's a seller. There's a seller, there's a buyer. So me as a trader, my job is I need to figure out where institutions are buying or selling. So if price is now being driven by news that creates supply and demand, so there's not three components by it based on price, you have news that now goes to the second component, which is that's driven now supplier demand, which now creates a direction, which now are trends. So those three elements are very important, with a component of technical analysis of price and time. And if you are a forecaster, you're a technical analyst, then it's also very important to know the other third component, which is now distance. So you have price, time, you have the future, which is the unknown, but you have the distance aspect on how far you can calculate where price is going to go, either up or down. Okay, so that's simply or the basic element of it as a form of review. So do you have any questions there, Jerome? Does it make sense?
That's all good there.
Okay, great. And who do we have? Oh, Lobster, Terminal. Okay, nice meeting you. If you have any questions there, Buzzard, by all means, ask, because this is also pretty much a Q&A workshop / giving you some, based on my understanding, based on my experience as a technical analyst, okay? All right, the question now is, how do you go, or how do you define turning points? This is what I love, or I call it my a sequential transitioning system. Once you can define that, oh man, then you'll be ahead out of everybody. So I'm gonna erase this. If you're taking notes, by all means take notes. No.
So you call it sequential what?
Transitioning system. Everything has a sequence. As a physicist, I mean, in mathematics, everything has its own sequence, right? 1, 2, 3, 4. What's after 4 is 5. It cannot go from 5 to 8. Harmonics, law of harmonic vibration is also the same. It goes. There's a sequence in terms of harmonics. Likewise for Newton's laws. Newton's laws has certain sequence, right? And hence, this is where technical analysis actually, the beauty once you see technical analysis in its purest form, it's actually very pretty, very beautiful. It's really, really good to look at. Okay, let me clear my drawings. So when markets or charts, they vibrate. Hence, that creates the harmonics, the vibration to go up and down. It cannot go in a straight line. Even when in regards to a bar, one bar, because this is a two-dimensional chart, but if you look at the third dimension of it, every bar will vibrate. Inside of it, there's a vibration. And I'll prove it to you. If I go now through a 1 minute time frame, everything that you see fit from when it opened at 9:30 to where it's at, notice that is also vibrating. From 9:30 to almost 1 o'clock, opening, low, high, closing. Notice on a daily time frame, it's just one straight bullish bar, hence the vibration of it. Multiple time frame analysis is so important when you're trading, especially depending on the intent, depending on your style, your behavior, and hence it's also important to know your profile as a trader, where you're at based on risk. So what is a sequence? A sequence is simply either a number or a letter followed by something. When you're driving a car from neutral, if you're driving a manual car from first gear, second gear, third gear, fourth gear, fifth gear, sixth gear, you want to change gear from sixth to fourth, you can do that. In most cases, from sixth to fifth, fifth to fourth, fourth to third, third to second, back to first, back to neutral, right? So the markets, on the other hand, they only have 4 sequences. So let's go first and define what trends are. Well, number one, you need to know about price. What drives price? And we looked into that. Price is driven by news. What are the news that you need to look for that will create the demand or supply for it without you second guessing, oh, it's going up. It looks like it's going to go up, so I'm going to buy as well. Just because the dynamics actually of price will now change based on the location of the price within that instance. For example, right now, price is 26,667. The price is at supply. When you're buying at supply, what happens to the risk?
Increases.
Oh, absolutely. By thousandfold. So based on law of supply and demand, you cannot buy at supply. The thing that I'm always mind-boggled about is that why do we as retail traders buy at supply? I mean, it happens to everybody. It happens to me too, especially when we are not aware, we're not very meticulous in regards to our own analysis. Oh, but it's bullish. But the price is above an indicator. We gotta buy. No, but just because it's at supply, or it's just because it is bullish, doesn't necessarily mean that it's going to keep on continuing in order for price to go up. You need, once again, enough force or power in order for the price to be broken. In other words, you need some form of information for the price to go beyond 27,000. So if you're projecting, you're forecasting the price is going to go to 27,000 or 27,500, then you need to have enough evidence why the price will go to 27,500. If you don't have the piece of information, don't do it. So, is it now then better to buy at a breakout of a supply that becomes demand? Yes. But when price is at supply, then the most logical, based on the law of supply and demand, is that you have to sell at a level of supply because the risk is very small. Does it make sense there? Based on supply and demand, right? That's why the dynamics is an important element, knowing the components, the laws of it. Now, what creates trends? Well, let's define an uptrend. What is the definition of an uptrend?
Higher highs and higher lows.
Bingo, higher highs and higher lows. So that being said, there's only four part of the sequence: higher high and higher lows. So what is a higher high? What is a higher low? It just simply means that when the low is higher compared to the previous low, then you have a higher low. You have 0.1, 0.2, 0.3. Then what's the next part of the sequence? In order to create an uptrend, you need a fourth point. The pivoting point has to be higher compared to the last pivoting point. That now creates a higher high. When you have a higher high and a higher low, then all of a sudden it drops and it creates another higher low. Then what's the next part of the sequence again? A higher high, a higher low, until that sequence changes to a lower high. When you now have a lower high, then what's now the next part of the sequence there, Jerome?
Lower low.
Lower low. Absolutely. So there's also minor ones and major ones. And this is the whole point of Elliott wave theory. And Elliott wave theory is just basically based on harmonic vibration. They just made it as an Elliott wave theory. It's a theory. Then you have your ABCs, right? But everything is based on those sequences. When I fully understood in terms of the actual definition objectively of what trends are, and then just going through it, I'm like, oh my God, the answer is there in front of me all along. So if we're going through all this and looking at the whole chart right here, it is also imperative to determine the major pivot points and the minor pivot points. If this is the last high, which is now your major high, where is your major low? This is your major low. In between here, that creates the impulse. Corrections, impulsions versus corrections. Notice this is now the impulse as well. But this impulse is also a correction on a bigger scale of things. Okay, so I'll erase it so you can see. Actually, let me minimize this. That impulse is a correction of this impulse. And that's also the whole point of your fibs.
You got too much stuff on there. You go back and show me what you wanted to teach me there.
Okay. Let me clear all my drawings right there. So if I minimize my screen, I minimize my chart. I know there's a bit of a lag in there. This whole segment is a correction of this impulse. Of course, as a daily time frame, it's very much more clearer if I change it to a monthly time frame. This impulse is a correction of this major impulse. And this is the whole point of retracements. $23.6, 38.2, heading towards the 50th percentile. And if you're dealing here with level of confluences, notice in terms of the confluence levels, at 30.2 is very strong, almost close to the 50th. And the reason also to notice the closing price goes above the 38.2. Mind you that they're just also a form of guidelines. Any form of indicators are just guidelines to our own analysis. We can also go through here and there. This is a strong confluence area. The strongest one here too is this level right here. Okay. So if this is a correction of this impulse, then potentially we have 2 more weeks, actually a week and a half for April to finish. It all depends on what the market will dictate. If it breaks through this high, then a continuation of the bullish move will continue. However, if they're not willing to do that, and if the high of 26,695 is a strong number, and it's going to create a lower high, then this is going to continue. You have now a lower low, you have a lower high, and lower low will be the next one. So right at this point in time, based on a very long-term time frame of the monthly, nothing dictating it that this is going to fail as yet. As far as I'm concerned, looking at it objectively, they could potentially break 26,961 to continue its trend to the upside unless things change based on whatever news that will occur. So in other words, we need to figure out now until the end of the month, what are the major news that could affect price, either to push the price beyond 26,696, or no one's willing to go beyond that, and it's going to fail. Wednesday, nothing is on the CAD. I'm just looking at the US news right here. Thursday, you have core durable goods. Friday, advanced GDP. Maybe, maybe not. How about next week? Well, nothing. You only have medium impact news. 30th, nothing. Tuesday, consumer confidence. No. How about Wednesday, May 1st? Well, we have federal funds rate, FOMC statement. So potentially, depending on what they're going to do, well, at this point in time, based on their forecast, there's no change of interest rates. If they do increase the interest rates, then the dollar index will keep going up, and definitely the market's going to tank. So it all depends on the projection. If Government is still stating, hey, there's no change of interest rates, want to keep on going, you want to keep lowering things, or are they going to say, well, in order for, well, oil is very expensive at this point in time, so they need to pump more oil. The only way for oil to do that is to increase the US dollar, right? So once the dollar goes higher a little bit, the price of oil will drop, and hence, so all this, the whole dynamics will change in the whole global economy. If it will then happens, then markets will keep on going up as well, right? So there, these are the things we need to look at that could potentially, well, okay, non-farm payroll on Friday next week. So if that would be the case, then this week and next week. On the weekly time frame, on the other hand, notice when it comes to force, there's a decrease in force. So it's awesome. If there's a decrease in force, then if I put a momentum indicator there, RSI momentum, or RSI indicator, or any form of oscillator, I bet you it's way overbought. So if things are way overbought, and here they're getting ready, either they will push the price up, or this is going to fail. Okay, so those are the things that we're looking for. Now, if you have a definition of higher highs and higher lows, lower highs, lower lows, so if next week you'll see a lower high and lower low that creates a pivoting point and will now create a lower high, bam, and that's not it, then that's when I'm going to start shorting. Make sense there, Jerome?
So it looks like you got a triple top there too.
That's what causes double bottoms, double tops, triple bottoms, triple tops. So here is now a tip. You have a higher high. You have a lower low. If you have a higher low and this didn't exist, then you have a higher probability of having a higher high. Everything here, these are your minor higher lows, minor lower highs, minor higher highs, minor lower highs, minor lower lows, minor higher high, minor higher high. If you're seeing this and you have a pivoting point that will create now a lower high, not a higher high, this is going to tank all the way down here, either to create a lower low or a retest back to 22,500 to create a higher low until it changes to create a new higher high somewhere sometime. So that is the sequence.
So is that just an explanation or your projection? No.
It's not a projection, it is a sequence. Once you have a sequence, those are the only two major sequences of what the market can do. No more, no less. There's no third, there's no fourth. Because that's what the definition of a trend is, objectively. Higher highs, higher lows for an uptrend, lower lows, lower highs for a downtrend.
So the 22,250 level is a projection from the current high.
From the current high, of course, based on supply and demand, they need to retest certain price points. They will retest that, they will retest this, and then they will retest this major low right here, which is your major area of demand, that either will create a higher low or a lower low. And in between, you'll also have your minor highs and lows. Therefore, mathematically, law of angles, and these are now basically advanced technical analysis stuff. So if there's an angle on where it would drop, and that's part of your forecasting, approximately based on the angle, and you have your two components, April, May, June, July, August, September. So from May all the way to September, you're in a downtrend. You cannot go long. Notice here from December all the way to where we're at, you're in an uptrend. If you go forward, you're screwed. You won't make money because you're in an uptrend within that time frame. From September, October, all the way to December, you're in a downtrend. You cannot go long. So that's based on these time frames. It all depends now if you're a day trader. If you're a day trader, then you cannot go long. You have to short because the market is going to keep dropping. Now, but if you're a long-term trader and you're a trend follower, then when price dropped to the major one right here on the 50th percentile or even the 38.2 percentile of the correction, you got to buy because long-term, it's going to go up, right? So that being said, what we're doing here, or what I'm doing, is simply I am waiting. I am waiting for next week, once again, whether if this is someone, so by Friday, if no one's willing to go beyond 26,496, then 26, which is the high of today, then next week, if it will come back, it will drop, and come back again, and you have, I'll say, a lower high, then that's where the pivoting point of you shorting is
So
the highest probability.
382, 50%, 61.8, and 786.
Mm-hmm. Mainly the 38, 50, and 62, right? The magic threes. If it breaks 60, the 62 percentile, easy. It will head either to the 70% percentile down to its starting point of zero. And if it breaks through that zero, then by Fibonacci law, it's going to keep dropping another 100% to the downside. By law, mathematically. So yeah, so the key to answer your question is looking, depending on the time frame you're at. Of course, the higher time frame has bigger hierarchy. So, and if you're good in technical analysis of candlesticks, especially if you have a gravestone doji at level of supply, like something like this, a lot of buying pressure, then selling pressure basically came back in. The probability that it's going to keep dropping is highly probable. However, if you have a hangman, you know, or a shooting star on the top, then it could potentially continue, the price will continue further to the upside. Why? Because there's a lot of selling pressure. So for argument's sake, something like this, a lot of selling pressure, and in the end, buying pressure pushed in, followed from the very bullish candle. The odds it will continue is highly probable based on that. So, but if next week you have a bearish candle, either an engulfing, but you have a clear cut of a lower high in terms of its highs, then you have a pivoting point. I'm waiting for it to basically drop. Last couple weeks ago, it created a lower high. However, it wasn't as strong because of this hangman followed by two bullish candles. That's why there's a continuation. But notice in terms of continuation, you have a decrease in force. Force equals mass times acceleration. Mass is simply the overall volume based on transactions of buying and selling. And an acceleration is simply the volatility of price, right? That the velocity. Hence, there's not enough push. So you can tell that it's way overbought. So the odds and probability that this is going to fail is highly probable unless that May or next week, based on federal funds rate, FOMC, non-farm payroll, if you have good news, then they will break it out and everything is seafood based on this area of supply will become now a new demand and price will continue all the way and we'll find new price points based on mathematical calculation once again. Okay, so yeah, so that's where we're in a pinnacle area right here. And then just when you check your commitment of traders to back up your claim, if you can see that institutions are been shorting the markets for X amount of weeks and they're still shorting, then you're in the money, basically. Hope that makes sense there, Jerome.
Yes. So the color bands are generated by the fib levels.
Say that again, please, Jerome.
The color bands are generated by the fib levels.
The color bands. This one right here?
And green, light green, dark green.
Yeah, so these were based on those few bells that we wrote, right? Oh, that we drew. So
Okay.
it's top to bottom. And I did a level of confluence. Confluence points are simply price points of where it's strongest. Because not every single price point will be the same price point in the past. Because it's like an auction house, it's a give or take, plus or minus. But when you have confluences where the prices are very close to each other, then that's solid. It is very strong, very powerful. Like this one, the 38.2 with the 50th percentile. That's a very strong price point. This 38.2, not as strong. So as one notice here, just broke out, penetrated across like, very easily. Same thing with here, penetrated, and hence heading now back to zero. And if it breaks through zero, then Fibonacci extensions will be put into place. And you can see once again where next price points, potential price points are going to be. Nice, good question. Very good. But that is the sequential, I call it the sequential transition system. From a lower low, it has to be now lower high, unless they change from a lower high to a higher high. When there's a higher high, there is a higher low. And when there is a higher low, then there's going to be a higher high. And then if it didn't want to create a higher low, it created a new lower low, then it has to be lower high. So that's how head and shoulders are being formed, reverse head and shoulders, triple tops, triple bottoms. Because at the beginning, like, I've been taught about price patterns. And like it doesn't make any sense. Well, it's double top, then it should be, it has to fail. But what I didn't see, which they didn't explain, is, hey, look, you have a higher high, even though it's a double top, but you have a higher high. It's going to keep going. There's a breakout. And these are the things that why, in terms of inconsistencies of results, basically happen. But of course, if you're not aware as well of your own emotions, sometimes we choose to see things in ways of what we want to see. and then our ego kicks in, then the results will still vary and still change. Right? That's why I'm taking time to look at it, being meticulous, being aware of our thoughts, our emotions are need to be included in regards to the analysis part. Great. Hi, Fu, or Fulian. Nice seeing you online. If you have any questions based on technical analysis, please feel free. Just unmute your mic and ask. So Jerome's question was, how do you determine turning points? And I just basically explained how to do that. Oh, here's a good example. So Jerome, here's a great example. See, look, you have lower lows, lower highs, higher low. From a higher low, higher high, based on this last plan. Minor, minor, major. Higher high, lower high, lower low. All of a sudden, major news broke out, lower low, continuation, lower low. So from a lower low, from a here corrected point, lower high. Notice 2 uncertainty candles in a row based on this big push. Failure. They didn't want to pursue, to break out, to create a new higher high. Instead, you have a lot of bearish candles right there. Look at that magnitude of force. And this is what I mean in regards to, see, you have a lower low, higher low, which now created a pivoting point. This is now a major higher low. And that's why the highs and lows are very important. And then it took 1, 2. Notice that in terms of the low, it didn't want to go below this low. So you have 2 consecutive higher lows. This is now a minor higher low. And notice, creating now new higher high. That's what I mean. These are the sequence, the sequential transition system. Very powerful stuff. Okay. Correction, continuation, which now create a new higher high, higher low, higher high. And
So what's the wave count right now then?
That's the thing. Like, I don't use the wave count, and the reason being is because for me, I use more of law of angles for me. But at the same time, it is also, since I'm a price reader, I go through candle by candle based on that sequence. In most cases, in terms of correction, is always a wave count of 3. 1, 2, 3, and then push. In regards to continuation of trends, sometimes it could lead more than that. Like say this one, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, right? So I use an indicator. For me, since I'm a trend follower, then I use a moving average indicator for me. As long as the price is still above the moving averages, then I'm still in an uptrend. But once that price changes now below the moving average, then have a potential change of trend. So that's why I have those. But when it comes to the sequence, based on just my experience and my style of trading, is simply I need to define the major trend and the minor trend. So I also, when I teach major highs, like a primary, uptrend, secondary, tertiary, quaternary, quaternary, and so forth, because they're very highly objective and price will change also from there. If they break through, say from a tertiary, then it has to come back down to the secondary. If it breaks through the secondary, it has to go to primary. If the primary gets broken, then that's where now you're in trouble because that's where price on a bigger scale of things. So like say for example, this one, this is my primary as of from 2009. So notice the sense of separation from price to the primary. So in regards to distance, I hold this is my secondary. It's a condition, it's an if and then statement, right? Price will have to reach first the secondary and will break up the secondary before we go to the primary. However, just imagine from there all the way down to here, oh, approximately there. That's 5,000 points, at least 20% in terms of drop. And mind you, this is a vertical drop.
Do you have a forecast time projection with that somehow?
Well, this one is interesting because, okay, if I go through here, then 68, 80, about 500, 700 days, 721 days, about approximately 100 bars to drop around 21% to the downside. Only if a lower high will be formed. So in other
That's in
words,
about 2 years.
yes, for the next 2 years, you'll be in a downtrend. Only if a lower high will be formed. But if the lower high won't form, you create a new higher high, then as far as I'm concerned, the price will keep going to 28,000, 29,000 in the next 2 to 3 years. Right? So, but as they say, when price drops, it will drop faster than it will go up. Yeah. Then if that would be the case, then it will drop maybe 120 days, depending on how fast it will drop. Even 20% right there to create a new low there.
So is this all built into TradingView, or does that you have an add-on?
This is TradingView. Yes, it is built in with TradingView. So I like
You heard
TradingView.
good stuff about TradingView.
Oh yeah, TradingView is awesome. Right. So yeah, so that's where you as an options trader, you will be able to determine approximately on how far you're willing to go based on your style and your strategy. Right. So, but at this point in time, premium probably be very cheap if you are gonna go short. Okay. Well,
What else have you been up to then?
I aside from teaching, my other passion is actually I created an anti-bullying self-defense programs for schools. So I teach in 3 different schools in the afternoons for the week, depending on which day. Educating kids about bullying from physical to emotional to cyberbullying and teaching them self-defense. And the beauty about what I do is simply for me, it's very similar to martial arts or like trading. It's just on a different manifestation. That's all.
So
Because when we're
public and
trading,
private schools?
currently in public schools, one at Half Elementary where my kids are, through after school programs in 2 different schools. And then as of next, after summer, I'll be teaching at Graham Middle School, Gun High School. So yeah, so those are the things I've been focusing on because uh, as a personal trainer, there's a few athletes, actually not an athlete, some students that I heard are currently depressed, either depressed, some students because of the bullying that they're being experiencing from other students. It's actually very interesting. So that's my other work, which I do love, giving back also to the community. Um, and yeah, because in my like trading for me, despite you think it's about technical analysis, at the end of the day, it's not about that. It's about ourselves, right? About our own values and principles, our own inner beliefs. And so if we have too much ego, there's no way that we would be able to make money because we're too righteous. So if we get rid of that and be objective, but it takes a lot of courage to be in a space of self, because sometimes it does kick in when we're not aware, and then the hope comes into place, or we tend to forget about the intuitive process. Once we forget our intuition, which is our own self as well, because the monkey mind plays a big role, and that's how we make mistakes, and which also gets translated from our inner child is right with kids. Kids are very mean, right? You know, they can say whatever they want to say, and it'll affect other kids. So it's why if I could do that too, and going through the root source and letting kids being aware of what they say, to think before they speak and show kindness to everybody, then things will change. Right? Because whether we like it or not, bullying still happens, sometimes in closed doors. So that's what I've been doing, Jerome.
All right. What are
Yeah.
you doing on May 2nd evening,
May 2nd evening, that is
Thursday night?
Thursday night. To be honest with you, I don't know. Is there any what's going on May 2nd, Jerome?
So, um, one of the leaders from the AAI group had passed away,
Oh, I'm sorry to hear that.
and there's some chance now that things are going to be, taking a different direction, let's say, or something like that.
Mm-hmm.
And I think it'd be great if you'd show up. They meet over at Holders on Deanza, across from the Home Depot.
Okay.
So six o'clock next Thursday.
So, can you please do me a favor, Jerome? If you can send me an email, I would greatly appreciate it. And I'll check my schedule and move things around and see if I will be able to make it.
Sure. And then just go to your site, then ESTEE.
Traders at gmail.com. Yes, please. Let me type it in just in case. Shu, do you have any questions by any chance? Also give you an opportunity. Just got into the office. No worries, Shu. Uh,
And then the TOPS group is looking for somebody to speak this summer too.
okay. Yeah, if you're, I'm more than happy to share what I know. Yes, I recorded it for you, so I will put that in online by tonight. Yeah.
Your address went away.
Oh, okay. Yeah, right there. ESD traders at Gmail. Did you get it?
Uh,
I put it in the chat box.
it's not there anymore.
Oh, that's weird.
Oh,
Hmm.
wonder why I don't see it. Oh, I got to go to the chat there. Okay.
Yeah, there it is. All right.
And
Nice.
you still have your Santa Clara training center?
To be honest with you, when Zoom came into very popular, people just wanted to go online. So I shut it down and I did mainly more on a Zoom conference and video conferencing. And yeah, it actually works better for everybody. Save me money to pay with the rent and so forth. So yeah, I've been doing more a lot of video conference, but of course, there's nothing better than one-on-one, to be honest. But I'm looking for a spot just to have meetings, like for the meetup group. There's one guy basically offered to use his office space, so I might get back in contact with him to make an appointment and see if we'll be able to have a meeting next month. But please feel free. I mean, if you know anyone, like I'm more than happy to share as well my experience simply in either technical analysis, a combination of technical analysis and the emotional component. Because as you would know, I mean, you guys are traders, right? It could be challenging because the emotions. If we have, as long as we have emotions and we cannot control that emotions, even how good we are as technical analysts, and we're not mindful, we can make mistakes, and sometimes those mistakes could be very costly. All righty. Well, thank you very much for coming in. Thanks, Jerome. I hope you learned a lot from there today. And
I hope we got some other people joining us.
right, well, there's only two currently. I mean, there are people. That's always the case. 10 people registered. Out of those 10, 20% or 30% will always show up. But it's okay. And even if you give them reminders, sometimes people forget, I guess.
And you
Whereas
said this is recorded?
it's recorded, yeah.
And can you watch the replay then?
Absolutely.
Where do you do that at?
I am going to upload it and then I'm going to put it on YouTube. And you can, or I'll put it on my, on a blog and you guys can watch it.
So I'm
So
getting
I'll do it.
emails from you, but I'm not on your blog.
No? Okay. Let me, I can add you in there, Jerome. All right, guys. Enjoy. Have a good lunch, okay? Thank you for coming in. I will see you guys next time.
Thank you. Looking forward to see you on the 2nd.
In a second. Thank you. Bye.